What's up, everybody? Joe Brown here. This is the Heresy Financial Show, and the big question on everybody's mind is how long can this craziness last before something breaks, before everything starts to collapse? And I'm going to share with you the one secret weapon that the Federal Reserve currently still has, and they've not fired this. They are keeping it and making sure that at the right time they can release. They've got, let's see here, about $1.8 trillion that they can release into the bond markets to go and send it out to go buy short-term government debt in order to stop and kick the can down the road a little bit longer. Ready? Let's dive in. All right, guys, so I've talked about this plenty of times before, but it is worth bringing up again because it is still an unused weapon that the Federal Reserve has. Take a look with me at this chart. We are looking at the reverse repo market, reverse repo facility, I should say, at the Federal Reserve. We can see there is just about $1.8 trillion in this facility, and it really started to get used back in March and April of last year. About 1 year ago is when a bunch of money started getting sucked into this, and it's been fairly consistent around $1.5 to $1.8 trillion since late last year. Now, a little bit of a primer just in case you're new here on what is going on here. The repo market is very basically where banks go to get cash. At the end of the day, they say, hey, we need some extra cash. We've got a lot of treasuries or mortgage-backed securities, some collateral, but we don't have cash. So they go out to all the other banks and they say, hey, does anybody have cash? We will sell you our treasuries for cash, and then we promise to repurchase those treasuries at a future date. And for the most part, most of the other banks will say yes. Now, in a repo market crisis like we had in September of 2019, or what prompted the Lehman crisis, you either have not enough cash or bad collateral. So in both of those instances, everybody was going with their collateral to the repo market and saying, hey, we've got a bunch of collateral, we want to sell it, and then nobody wanted to take that collateral because either nobody had the cash or nobody liked that collateral. Now, the Federal Reserve has two repo facilities. They've got the regular repo facility and they've got the reverse repo facility. The regular repo facility is available now to many institutions. Didn't used to be available to only a select few, and that was where those select few institutions could go directly to the Federal Reserve and say, hey, none of these other banks want to give us cash, so how about we do that with you? And the Federal Reserve started increasing the amount of institutions and the amount of cash they were offering into the repo market through that facility in September of 2019. Now, in the fallout of COVID, dealing with that, all the government spending, the inflationary financing of government debt, the trillions of dollars spent into existence, there was a cash glut. Too much cash entered the economy, and so the Federal Reserve didn't want all that cash to push interest rates negative because all that cash eventually makes its way into bank accounts, and then it goes to purchase treasuries or short-term government debt like bills and notes, and so they didn't want it pushing rates negative. That's a lot of cash going in to buy that debt that had the potential to push rates negative. So in April of 2021, the Federal Reserve started increasing the interest rates on the reverse repo facility. And you can see here, for this whole entire time, COVID started, and this entire time, the reverse repo rate was 0. They weren't offering any there. And then in June of 2021, they increased the interest rate to 0.5%. Now, I said that it started attracting the extra money in March and April of 2021, and that's because that's when the supplementary leverage ratio suspension ended. And so that's when banks were required to get their hands on collateral again, which they weren't before. And then you can see right about June here, it was right in here when they increased the interest rate that they were offering for this reverse repo facility. So in this situation, remember, it's the opposite of the repo crisis. In this situation, the entire financial system is saying, hey, we've got too much cash, we need collateral. And the Federal Reserve said, hey, come get your collateral from us instead of your cash. That's repo is come get cash. Reverse repo is come get collateral. They said, and we'll pay you a hefty rate, 0.05%. And so it sucked a bunch of cash into the reverse repo facility. Now, keep in mind, this money, if interest rates go back down to 0 in the reverse repo facility, there's $1.8 trillion in there that no longer wants to be there. It's there because it's getting free interest with no risk. And not only that, the Federal Reserve just increased the interest rate a month ago in this facility to 0.3%. They want to keep that cash in there until the very last moment, until they must release it, because this is a $1.8 trillion weapon that they can release and push out of there if they drop that reverse repo facility rate to 0%. All that money then floods back out and goes back out to buy other debt. Now, you might be asking, hey, well, 2-year, 10-year, 30-year, is way higher than 0.3% right now. Why is that not sucking money out of this facility yet? It's because of the liquidity. There's no risk here of buying a 10-year treasury and then having the price of that treasury fall while interest rates are rising. This is money that is needed for liquidity purposes. They need that guaranteed rate. They need it to be able to pull out at any point they want. And so that is why you see all this money staying in there right now, because the rate has increased. It has become more competitive. And at the point at which the entire yield curve turns very steeply negative, or at the point in which there starts to be a crisis where there's no more buying, let's say government debt auctions, treasury auctions, no buyers are coming in, let's say you have something massively unexpected happen, they're going to release this. They're going to plunge that reverse repo rate all the way back down to zero, and all this money is going to flood back out, and it's going to be forced into short-term government debt, buying all that up, which price goes up, interest rates go down on debt. And so that is the Federal Reserve's secret weapon that they are still holding, and that's not something that's a permanent fix. $1.8 trillion, it'll have an impact 100%. It's not going to be a total fix. It's just a temporary stopgap, and they're going to just do this until they figure out the next solution to the next time they need to do something, which who knows how long it'll be before something like that happens. But I expect that sometime towards the end of this year, the Federal Reserve is going to have to release all the funds from this reverse repo facility. Actually, not release, just push them out by forcing the reverse repo rate back down to zero. And finally, on May 6th through 8th, I will be speaking at the Market Disruptors Live Conference. It is in Dallas this year. Last year's was a great event. For those of you who I met there, that was a lot of fun. Love to see you there again this year. It's going to be a great event. There's tons of heavy hitters speaking there. We've got Luke Groman, Daniel DiMartino Booth, George Gammon, Harry Dent, Cody Sanchez, Jeff Booth, Robert Breedlove, Greg Foss, plenty of other heavy hitters. It's going to be a fantastic event. Love to see you there. Link to sign up is in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.